Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's about 30 minutes to go now until the closing bell, and stocks are sinking as banks and big tech weigh on the major averages. Our very own Ines Ferre is standing by with the headlines. Ines.
Josh, right across the board when it comes to equities, let's take a look at the Dow. It's down about 0.1%, but we're off the lows of the session for the Dow. The Nasdaq down 1.1%, also a bit off the lows. And then just taking a look at the S&P 500 down 0.6%. Certainly tech has been leading to the downside, tech stocks. And if we take a look at the Nasdaq 100, we're looking at Nvidia down more than 1.5%, Amazon down 2%, Microsoft, Meta, Tesla, pretty much all the Mag 7s are under pressure. Also looking at Broadcom, that is down more than 4%. Taking a look at the crypto related space, that is in the green. And we have seen a bit of a rally this week when it comes to crypto. Bitcoin up more than 3%. A bill in the Senate really is what's driving some of this optimism around the industry right now. We are seeing also Ethereum up more than 4% as well. Taking a look at commodities where we've seen quite a bit of action recently, we are seeing that oil has reversed course. It was up more than 1.5% during the highs of the session, but some commentary that President Trump said about Iran has sent oil tumbling now. So we are watching futures for crude down more than 1.5%. Brent crude also going into negative territory as well. What hasn't been going into negative territory is the metals market. So gold has again touched all-time highs. We're looking at gold futures above 4,600 and also silver futures above $93 per ounce. So a high for silver. Silver year to date, by the way, after that monster rally last year, year to date now up 31%. This is 2 weeks that we've only been in 2026. And also copper prices at new highs as well. Josh.
All right, Nez, thank you.
Thank you.
Well, economic data getting overshadowed in markets once again as big banks and big tech send all three major averages lower. Joining me now on this are Argent Capital Management Portfolio Manager Jed Ellerbrook and Luke Tilley, Wilmington Trust Chief Economist and former Philadelphia Fed Economic Advisor. Guys, welcome to you both. Luke, I'll start with you as the economist on the panel here. We got a rush of economic data this morning, Luke. You got retail sales, wholesale inflation, existing home sales. What'd you make of what you saw today, Luke? And just also more generally, your overall take on the economy, Luke, where we are and where you think we're headed.
Yeah, sure, Josh. I thought that this morning's retail sales report, even though it sort of drove headlines and there was a lot of positive reaction, when you take it with a couple of weaker months that we've had previously, it really kind of looks like a slowing consumer. When we correct for retail sales over the past 3 months, they've moved into negative territory once you correct for inflation, because the things that really made the retail sales pop in today's report, and so this was November retail sales, things like clothing, apparel, sporting goods, and a lot of those we can see in the CPI data had pretty steep price increases driven by tariffs and some other things. So if we're thinking about real GDP and what's going on with consumer spending, it has really slowed. And that calculation that we have of year over year, real retail sales is now slowed to below 2%. We have it at 1.7%, whereas it started the year right around 4%. So we see a slowdown there. And of course, that would be expected given the slow job growth that we've had. And so we continue to see just a slowing of the consumer, not a decline, not a retrenchment, but a little bit of a slowdown. I think the good news there is that, like you said, we got some wholesale prices, and that combined with the CPI report, we continue to see slowing inflation. And we think the Fed's going to be cutting rates even before mid-year. We think they'll cut multiple times, Josh.
Jed, I want to bring you in as well and get your take on the economy as well, Jed. I thought some of the commentary, Jed, that we were getting from those big bank CEOs, I thought that was interesting, their take. Here's Bank of America CEO Brian Moynihan today. Consumers resilient, he says. Businesses resilient. We are bullish on the economy in 2026. Jamie Dimon yesterday, U.S. economy remains resilient, he says. Consumers continue to spend. Businesses are healthy. He says these conditions could persist for some time. What do you make of it, Jed?
Yeah, I agree with Luke's points earlier. I think his perspective is right. You're also right. The big bank commentary has been mostly positive. I'll throw in there Delta Airlines comments too. Their main point, as I took it, was main cabin kind of weak, first class trends, premium seating really strong, and a strong outlook. I think that's a pretty kind of clear story on the state of the consumer these days. And outside of this really big accelerated compute investment cycle we have going related to power and data center construction, I see a mostly slow growth, positive but slow growth economy.
So, Jed, we heard Luke and his take on the Fed. What's your base case for 2026? How many cuts?
Yeah, I think Luke is right. I think the market is projecting 2 today, if my memory serves, and I would take the over on that, over on 2 cuts in 2026.
Luke, what about Fed independence? I'm just curious how you're thinking about that, given recent headlines.
Yeah, I think that clearly the loss of Fed independence would be really troubling, as it would drive long-term bond yields higher. We see that in countries that have a central bank that's sort of captive to the fiscal authorities and to the president or prime minister. It's mostly emerging market economies that experience that. But the market reaction has been pretty muted since the announcement of the criminal investigation of Chair Powell, and that's because there are a lot of safeguards in place. One, we've already seen the Senate, members of the Senate Banking Committee come out pretty strongly against this. And that has always been a pretty good check on presidents from both administrations, usually behind closed doors. There's a lot of people who are mooted to be nominated to the Fed, and then sometimes they just sort of quietly retreat. Kevin Hassett, just a month ago was leading and then all of a sudden sort of faded. And I think that was discussions going on behind the scenes. The other part of it is that the Fed independence is really built in. President Trump only has one nomination if at the end of this month with Stephen Miran when his seat comes up. After that, if Chair Powell decided to stay on after his chairmanship ends in May, he could stay at the board until January of 2028. That would be unusual, but if he's worried about independence, he might do that. But those are the only 2 seats that are going to come up unless the firing of Lisa Cook goes through. So there's very little wiggle room for the president to nominate people to the Fed, and we think that the Fed independence will be maintained.
Jed, I want to bring you back here as well on another topic. That's, listen, international news continues to dominate. Geopolitics dominates Iran, Venezuela, Greenland. How, Jed, as an investor, are you thinking through that, navigating those dynamics?
Yeah, I feel like investors are being thrown curveballs at a rate never seen before by a presidential administration. No matter what sector you're investing in, whether it be tech or energy, industrials, financials, you can go on and on. I think an investor needs to have a firm grasp of their investment thesis behind each investment and then stick to that when a whole bunch of unrelated or adjacent noise comes at you from either the administration or earnings season or whatever. If you don't have that anchoring, you are bound to be whipped around to and fro by all the news that's being made every day by both the administration, but also the geopolitics stuff, energy market stuff. List goes on.
Luke, another theme here, and my colleague Ines was hitting on it. Gold and silver. I'm sure viewers are tired of hearing me saying it, but again, climbing to new highs again today, Luke, extending this just blistering rally. As an economist, Luke, how do you make sense of that? What message is that sending me?
I think it's a continue of a move to safe havens. We've seen the growth sector and the Nasdaq sell off a little bit today. You've got some nerves about where the U.S. is going, and there's a little bit of a sell America trade going on here. So they serve as safe havens, and a lot of investors move towards that, and I think understandably so, because it is a safe haven asset if other assets look like they could be, suspect to a decline, to a downfall in some way. So I think that an environment like this is going to drive it up on the day. More broadly, we're still optimistic about equities. We're neutral to them, not overly enthusiastic, but our investment committee is neutral to equities, neutral to fixed income, and we're waiting to see how the economic environment plays out. But certainly gold and silver are going to catch a bid on days like this, Josh.
Jed, I'll end with you here. Your top idea for 2026, Jed, your top buy, what would it be?
Yeah, this is where Luke and I depart. I'm a little bit more optimistic on the stock market here in 2026. And my favorite idea, largest overweight in our strategy, ticker ABIG, is Amazon. Amazon is liked by a lot of investors, but the stock hasn't done very well over the last year and a half due to a variety of factors, concerns about their cloud computing unit growing slower than peers, concerns about tariffs 9 months ago. But Amazon is set to do extremely well both in 2026 and going forward. Their cloud computing organic growth is going to pick up. It accelerated last quarter. That's going to continue for all of 2026. And margins in their retail business are going up, all while they're basically growing at twice the speed of every other big retailer in the country. So I think Amazon is an excellent business. I think it's being well managed by their CEO, Andy Jassy. And I expect, 20 to 30% earnings growth for the next 5 years.
Jed, I will tell you, I recently had Mark Mahaney and Doug Clinton on the show, two of the smartest tech analysts I know. They both agreed with you. They're both fans of Amazon. So you are in good company there. Jed, Luke, great to have both you guys on the show. Thank you.
Thank you.
Thanks.
Coming up, bank stocks selling off as policy risks overshadowed any positive results. An analyst breaks down the outlook for the financial sector. That's next on Market Domination. Existing home sales see a 5.1% rise in December, capping off a tough year for home buyers. And Yahoo Finance's Claire Boston joins now with the very latest. Claire, what did we learn?
Hi, Josh. So like you just said, 5.1% is the increase from November. That is a pretty solid gain. And it is coming as a result of lower mortgage rates. We are really seeing buyers start to come back to the market at these levels where mortgage rates are more like 6.2%. That being said, we also got full year data, and this is where the story is a little less good. We only saw 4.06 million homes sold in the US this year. And that is in 2025. That is tied with the worst level in 30 years with 2024. So absolutely no improvement in home sales for the full year. And we are still running a lot lower than average.
So that's sort of the national story. What about regionally, Claire? Are there certain interesting themes and trends out there?
Definitely. So like I said, we did see this increase in December, and mostly in the West and also the South, their sales were up over 6% in both regions. We also did see gains in the Midwest and in the Northeast of 2%. So we are seeing, doesn't matter where you are in the country, home sales are improving a little bit, but we'll have to see, is this going to last into these slow months?
Mortgage demand saw a spike. What contributed to that?
Yeah, so President Trump recently announced that the Fannie and Freddie, what we call the GSEs, are going to buy $200 billion of mortgage bonds. And mortgage rates responded. They moved lower, and we saw pretty much an immediate uptick in mortgage applications as well as refinancings. So it just really shows that buyers are really, really rate sensitive. They are paying attention to the news. And anytime mortgage rates move lower, they will kind of respond.
Finally, there are now more homeowners with 6% mortgage rates than 3%. What does that potentially signal about what's ahead?
Yeah, so for years in the housing market, we have been talking about this thing called the lock-in effect. And this is basically the idea that if you were lucky enough to have a 3% mortgage, you are absolutely not going to move in today's environments. But things happen. People do move. We are seeing that some people are willing to give up those ultra low rates. And generally, this is good news because the idea is, things are going to be a little more normalized and inventory will improve. And, the big thing, though, is that over half the market, they still have rates lower than 4%. I think it's going to be really hard to get rid of those rates and get those people to move.
All right, Claire, thank you. Appreciate it.
Thank you.
Well, bank earnings are in full swing and stocks are sinking even after posting solid quarterly results. For more, we're bringing in now Nathan Stovall, Director of Financial Institutions Research at S&P Global Market Intelligence. Nathan, it's good to see you. So let's dig into these results. So bank earnings, day two. Investors did seem disappointed. The big picture, it looked to me broadly, Nathan, that you had really solid results. So was this just a question, maybe just it wasn't enough, Nathan, after what had been some real strong runs here?
I think that's right. I really think it's more about valuation than the fundamental performance itself. When you think about fundamentals, you saw margin expansion, which was expected. You saw really strong loan growth, which we were hoping to see, and that came through. And importantly, credit quality really held up. Coming out of the third quarter, there was some concerns about cracks in the credit armor starting to appear. We really haven't seen it. So that was really positive. And you saw investment banking results continue to be positive, and most of the management teams express continued optimism about what we're seeing throughout the year. The issue was these stocks had a really, really strong run in 25, and particularly to end the year. When you look at the big bank index, they had outperformed the S&P by about 11% in 25. So a really strong run capped off with a really strong run in December. We've got Morgan and Goldman tomorrow, and they were even very much leading the way. So I think some of this is not so much concern about what the actual print was, but just simply taking some money off of the table because you had such a strong run. And then throw on top of that, maybe some uncertainty about what you're hearing from the policy front, both either on card or direction of the Fed, that I know you're talking a little bit about in the prior segment. But ultimately, really good fundamental performance from the group.
Nathan, what's also interesting is I feel like during earnings season, when you get ready to hear from the big banks, you could almost feel a lot of investors get into almost this defensive crouch, Nathan, and you're kind of wondering, okay, is this it? Is this the quarter when they're going to come out and they're going to say, you know what, the economy's cracking, the consumer's hitting a wall? But then you looked at this commentary, Nathan, that we got from Brian Moynihan or Jamie Dimon, and when you were listening to them talk about the economy, the consumer, businesses, it was broadly positive. And I'm just curious, though, to get your take.
No, I think that's right. And I think for the last few quarters, we've been in this group too. It feels like we're waking up every day waiting for the consumer to crack, waiting for the economy to crack. Because if you go back a long period of time, we've had a recession in this country almost every 7 or 8 years. And we didn't really have one in COVID, right? That was an absolute pause. So it's been all the way back to call it 12 or 13 since we've really, really had a downturn. So it feels like we're almost due at this point. And you've seen some weakness, some softness in the labor market. You've seen the consumer be a little bit stretched. But what you continue to hear from the management teams is that spending is holding up. They're not seeing real issues with the consumer despite sentiment somewhat waning. And they're not seeing any problems with their small business borrowing base. So they still feel pretty optimistic, I think. And one of the things that I think helps them feel better about the future is the fact that we've got some stimulus from things like tax cuts and deregulation coming this year. So still some win in the sales, but I think you framed it right that heading into the quarter, everybody is just worried, how much longer can this last? And one other thing that I would note, I mentioned earlier that not only has credit come up, when you look at all different kinds of components, yes, you had delinquencies rise for a few quarters in a row heading into 25, but they've really stabilized. And here in Q4, we didn't really see any further deterioration there. So that's something that should give you a lot of confidence, the fact that you would start to see loans going bad at a higher rate, across the board, particularly with things like early stage delinquencies and consumer credit. And we just really haven't seen it move that materially.
So now you heard from these big banks, Nathan. I'm curious, as you try to forecast, okay, what do you think earnings growth looks like in 2026? As you try and model that, what do you see?
I mean, we think it's going to be pretty darn strong, to be honest. We've got earnings going up about 10%, assuming that credit holds stable. If it deteriorates a little bit further, which we think is a good possibility, we've still got modest earnings growth across the group, and returns still being pretty favorable. We've probably been overly bearish on that, just with the idea that we're going to have a cycle at some point, and we thought we had continued credit normalization. But these early prints give some confidence that maybe there's a little bit further legs in the credit cycle here. Again, our baseline forecast is for earnings to go up a few percentage points, and that will be uneven across the group. Some banks will do better. The bigger guys with investment bankings and market businesses could outperform that. Those who are more reliant on lending for their earnings might be closer to that number that we see coming in. But even if there is deterioration, we're not expecting anything really that troubling and very much manageable, and still allow for greater capital return to investors. And when you think about the smaller regionals, still allow them to do things like more acquisitions, which we've seen bank M&A activity pick up in Q4. I think that would be a big story of 26 as well.
You mentioned something earlier, Nathan. I just want to circle back on President Trump's cap on credit card rates. We heard from Citi, Bank of America, JP Morgan executives making it clear they have some questions and concerns about that idea. I am curious, as an analyst who covers this space, how are you thinking through it?
I think all the banks were careful to not just throw it away is rhetoric. I mean, I think that they recognized that if it came to pass, it would be a big hit to their earnings. But I think also they recognize, and most do in the investment community, if it did come to pass, that it would really limit credit to a lot of consumers. One of the reasons why those rates are where they are is simply to compensate for the risk that these institutions are taking. So, I mean, if you had a credit cap, I think you'd find a lot of consumers pushed out of the card market and probably go to places where there are higher rates like payday loans. So I'm not so sure it would necessarily be good policy. Not so sure necessarily the president could do it either. It probably needs an act of Congress. But if it did come to pass, it would be a negative from an earnings standpoint. And I think a lot of the banks here who have already reported, we're trying to meet it and saying, look, we are focused on affordability. We're trying to serve our customer base. This is something we're really conscious of. But it would be a negative if it came to pass. But I would put not a lot of stock into it, and that the Congress would take hold of this.
Nathan, so good to have you on the show today. Thank you, sir.
Thank you.
Now time for some of today's trending tickers, starting with Intuitive Surgical Company sharing preliminary fourth quarter results that showed better than expected revenue and growth for its Da Vinci robotic surgical systems. Volume in 2025 was largely attributable to growth in U.S. general surgery procedures. However, looking further ahead to full year 2026, Da Vinci procedures are expected to increase about 13 to 15%, slightly missing analyst estimates. Next up, commodities continue to shine. Gold, silver, copper, surging. The metals climbing to new highs and extending an explosive rally in the first 2 weeks of January. Gold futures hit a high of $46.50 per troy ounce. Wall Street analysts have raised their forecasts in recent days in light of recent geopolitical tensions and growing questions about the Fed's independence. And lastly, Airbnb is making a tech move as it hires an AI expert as its chief technology officer. Ahmed Aldal joins Airbnb from Meta, where he led the team behind the Llama family of open source models. Ahmed also spent some time at Apple and was one of the technologists behind the iPhone's display and multi-touch systems, as well as a creator and leader of Apple's autonomous technology group. Well, we're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action. Follow the closing bell. Stay tuned for Market Domination. Over.